Hello YouTube, this is Steven with On My Way to Fire, a channel about early retirement and all things investing. And in today's video, I want to talk about letting GPT rate my investments and my investment knowledge. And you know guys, it's been probably about a year, maybe a little bit more, that the GPT app's been available. And I gotta say, I'm a frequent user multiple times a day, to the point that it says your usage is up, or use a new chat, you're out of data analysis for the moment. And I guess that's telling me it's time to get off. But you know, it's a really great tool, and I would say it's a good starting point to bounce some ideas off of. You know, you can pay an investment advisor for a fee-only service, but it's going to cost you a couple $100. You know, if you don't have like a big portfolio to manage, and even that, you're going to pay a 1% fee. And when you have questions, it's going to take time. You know, it's just so much easier to go this route. But I want to add some caveats before I get started here. The information that it has stored and available to you oftentimes is behind by about a year to a year and a half. And I've noticed this a lot with giving inaccurate information on a response. So a good example of this is I asked it about a Roth IRA, and if I funded it for the next 10 years, you know, and I gave it my starting balance of where I'm at currently, you know, what would that value be? Well, it gave the incorrect limit of $7,000, which was last year's limit, but this year it's $7,500. And, you know, when I questioned why it was wrong, it says oftentimes it's archived up to a certain date, and then it has to fetch the new information with a new search. So just be mindful when you're doing it. Use it as a guide. You know, you could do the create project or just write down what it's telling you, and then do your own search to kind of compare against it so that you know that you're getting current and up-to-date information. You know, something like that, it's only off by $500. But if you know, model it out 10 years, that's $5,000 in funding that's not being accounted for. So just keep all this in mind. You know, I also found this to be similar with other questions that I have. It was giving me Jerome Powell as the Fed chair when I asked it about the Fed's rate meeting here coming up in September. And I said, no, it's Warsh. And then it says, oh, you're right. So it's interesting that it just doesn't, you know, on the instant responses, it's archived up to a certain point, and then you might have to challenge it with an update, or, you know, tell it what you think is correct, and then it will bounce that and then tell you that, you know, what the initial response was wrong. All right, guys, so, you know, I've thrown so many questions at ChatGPT over the last year or so that it's gotten to know me pretty well. And I'll also add that I don't give it direct access to my account. I don't, you know, allow it to see my account number, my positions, or anything like that. But I give it a description, more or less, of the value and the types of investments they are. So, you know, oftentimes you'll hear me talk about qualified dividends. Those are on domestic U.S. stocks that pay a dividend. And then you have closed-end funds, preferred funds, REITs, and stuff like that. So I'll break it down by category so that it can kind of give me an analysis based off the tax treatment for each of those different asset types. But I don't give it direct access, and I don't give it screenshots or anything like that. So that's one way that I guard against it, because who knows what they're doing with this information. You know, they're probably building a profile on me. But, you know, with that in mind, I did ask it, what do you think my investment knowledge, and, like, you know, how would you rate me 1 out of 10 based off what I'm doing? Because my bigger overall goal is to retire at somewhere around age 53 to 55. You know, I'm keeping that open just in case, you know, things don't work out exactly as I want them to. You know, probably going back 10 years ago, my dream was to retire at 50. And, you know, I'll be 47 here coming up in the next month. So, you know, I've kind of had to adjust some of my own internal expectations of what I want to do. But it's given me a good guide and given me a, you know, a better sense, and refine the process as we get closer to that goal. So initially it rated me an 8.5 overall. And it said that my investment knowledge and tax awareness were at 8.5 out of 10. I'm always, you know, looking for opportunities on certain things, but, you know, I keep in mind the tax consequences on a brokerage account, and the idea of shifting some of those higher yielding investments that don't have qualified dividends, so I get hit at the highest tax rate, that I am actively trying to move those to a Roth IRA where there's no more tax. So that's good. It gave me that. So, you know, room for improvement. Retirement planning and long-term planning, it gave me a 9. It says I'm constantly looking out beyond just a year or two, you know, like decades out, you know, 5, 10 years, 20 years out, and asking for projections on what I can do based off small moves now if I stay consistent. So that can tie into one of my videos that I talked about, the magic of compounding. I talked about Realty Income, and they pay a monthly dividend. And I found that if I just added $30 a month, I can get that position well over $30,000 in about 20 years or so. So that was kind of cool to see that. Let's see here. Okay, and then portfolio construction and risk management. That's where it bumped me down to an 8. And that's because I hold a lot of company stock, and I have a lot of stocks that don't have favorable tax treatment, like I was talking about, the BDCs, the REITs, and the closed-end funds. And the other thing that it comes back to is that I have too much company stock. When I count all my investments combined, I'm somewhere around 31 to 34% of company stock, given the value of the stock at that time. So, most investment advisors recommend that you only have 10% in company stock overall. And I ignore that advice, guys. I don't want to play by the same rules and just sit around and wait for my investments to come back. I think that if you're actively knowledgeable and willing to react to the market at different times, there's opportunities for you to make more money. And, like I've talked in another video, they're constantly citing Enron and other companies that have scandals. That is a one-off. I'm willing to take that risk and double or triple down, and that's pretty much where I'm at now. But, to some people, they might say that's just way too much risk. But if you look at the situation on paper, I have a solid dividend with my company, and, by staying in it, I get paid that dividend. So essentially I get paid to wait. And, the stock's been down because it's a financial related company, and the interest rates are not coming down just yet. Now, I have a theory that based off manipulating the data and the CPI and how they, present this information to the public, the Federal Reserve can hold off on increasing interest rates meaningfully. There's a possibility that they do raise it somewhere between 1/4 and 1/2 point, I think, in the next year. But I think they'll eventually have to reverse it because they just cannot sustain the debt payments to all the things that the government spends, and they can't stop spending money. And so that's another thing I asked ChatGPT about. And it says, essentially you're correct. The spending never goes down with the government. And if they want to give us these tax cuts through the big, beautiful bill and other means, they're going to have to make up for it in other ways. And typically what they do is they grow themselves out of inflation. But, the inflation is put on the American public. So they just keep, basically increasing the money supply, which is called M2, and then also the bond market where they issue new bonds. They don't want to issue those bonds with high interest rates because it just costs the government more money. So think about it, every quarter point makes a huge difference to the government. So I think temporarily they could do it if they really had to prove to the market. A lot of these shows that I watch, they talk about the bond yields and how the bonds are responding faster than the Fed. It's interesting, but ultimately, the Fed is trying to make the argument that the high gas prices and the current rates where they are now are justified in, curbing spending. And if you compare that back to what it was during COVID, the rates are meaningfully higher, but they're not as bad as they were in the late 70s going into the mid 80s, So I think we got to put it in perspective and see what it is. But anyway, back to the whole point. I think that some of my investments will respond quite positively and rally somewhere between 50 and maybe even 15 to 50% if the interest rates get cut meaningfully. So, I'm thinking of 1/2 point to a full point from where we are now. So if they have to raise it a little bit, that's a possibility. I'm willing to put the time in and let the investments, compound from this point because, this is the opportunity cost. Okay. And, worst case, I get my money back if I have to sell some of the shares basically at par. I don't make any money. But, back to that main idea, they say that I'm too concentrated in certain aspects of, certain stocks, that I should diversify a little bit more. So I did, challenge it, saying 8.5. I push my risk when I see the opportunity cost in my favor. And if I'm already in a stock position, I'll put a little bit more in because I think I can make a higher percent down the road based off some sort of negative headline at the moment. So it did actually bump me up to 8.75 based off that, which I thought was kind of cool. And it gave me like a smiley face. And it's interesting because ChatGPT has kind of an interesting little personality in terms of being kind of funny and even empathetic at times to your questions and, just overall opinion of what you're doing yourself. So I find that kind of cool. So it did bump me up and said, the fact that you challenged me and that you told me some more information, I'll go ahead and give you an 8.75 as far as your overall investment approach and how you're doing. So in conclusion, I asked it, if I did reduce my company stock allocation below 20%, would you increase my rating? And it said yes. It would give me somewhere between a 9 and 9.25. So I thought that was pretty cool. And the overall takeaway was it says that I value, the timing of taking gains occasionally, but weighing it against the tax consequences depending on what kind of account it is. So I thought that was cool. It does recognize that. And it also says that you're starting to understand the diversification doesn't eliminate market risk. So that means that, having different investments across different asset classes doesn't take the market risk out of the equation, but it spreads it around. And by using this opportunity cost with looking at taking gains, I can take a little off the table here and there. And that helps me with building my portfolio over time, because basically I'm doing something in a system like accumulating shares, evaluating, continuing to buy no matter what into the market, but in different asset classes depending on what's in favor at the time and what's the best value in my opinion. And then at a certain point taking money off the table again and repeating the process, but always having a cash flow going into the market, but just knowing when to recognize when it's time to take money out of the market. So I do appreciate that, that it recognized that. Now, one thing I'll add here, just through my own trial and error, which was probably one of the biggest learning lessons when I got interested in investing, was I originally started with buying ETFs and a Roth IRA when I first started in 2014, really getting back into trading. And the other thing that I did was I started an account at Vanguard, and I got into their mutual funds. But at the time, I don't know if this is still true, but it was $3,000 to get into a mutual fund. So I had just enough to buy into 3 different funds. And then over the series of probably about a year, I built up each mutual fund to about $8,000 to $15,000. And you can do a thing where you get into a better cost basis or cost ratio, expense ratio, where it's called institutional. So I did that and I upgraded the shares on a couple of them. But anyway, the long story on this was I was in these mutual funds for about 2 years, and they went up between 5 and 20%. So I thought, okay, I'm doing great. But the dividends really weren't all that good. I had them deposit as cash, and then there was an issue somewhere around 2018 to 2019, I want to say, with the real estate fund, and that one went down, and it essentially went down to the exact price that I paid, and my 20% profit just evaporated right in front of my eyes. So my response to this was to, continue to buy shares while it was down. And so I put in probably about another $1,200 to $1,500, just buying $30 to $50 at a time, sometimes $100. And, once you're in a mutual fund, you can add 10 bucks, I think, on most of them. So it's not like you have to, put in the $3,000 again. That's just to get the account started. But anyway, so I put in another $1,500 or so in that one and one other fund that I had. And eventually the market did come back, and pretty much everything that I had at that point was a long-term capital gain. So even back then in 2019 to 2020, I sold these shares and got out completely of these mutual funds. And I did it just in time, because I think the last mutual fund I sold in January of 2020, and that's just right before the COVID crash. But I didn't want that money locked up anymore. And at that point, it was well over $20,000 in these mutual funds, and I thought I could do better investing it on my own. And that's where I went more into single stock investing. So, a lot of my knowledge and, journey has been just trial and error and seeing what's worked and learning some lessons that are sometimes initially a tough lesson, but seeing the opportunity in the negative situation. And that's where buying these shares at a reduction got me a little extra money when the mutual fund finally came back. So I hope this video was helpful to you. Do your own research, experiment around with ChatGPT. And if you want to just do like a test run, you can go to the DuckDuckGo browser, and they have a tab on there before you enter your search. And it uses a different version of ChatGPT that you can kind of run through some scenarios with. I don't believe it will remember the conversations like it would on the app, but it's pretty cool. And it's a good way just to get started with running some scenarios and questions, and getting some feedback. But again, just keep in mind that the information may not be fully up to date depending on what kind of question you're asking. So be willing to challenge it, write down the information, and do your own research in doing that. But anyway, guys, hope this video was good, and we'll see you in the next one. All right, bye.